All right, I'd like to welcome back to the show Nicole Heels. Now, Nicole, we're going to be talking today about share market basics. Last time we had you on, we spoke about the great debate, which was between shares and property. And if my memory serves me correctly, you basically said that the share market really is a collection of companies, and when we're buying shares, we're buying a small piece of one of them. Is there anything you wanted to add to that? Is that a fair explanation?
Yeah, basically the share market, you can call it the stock market as well. You're basically buying a part of a company. So the share market's made up of all different companies, and your share is a share in a company that's listed on the stock market. So that's really how you break that down. But yep, that's right.
So you hear the difference between traders and investors. So how would you define the difference between the two of them?
So a trader is somebody that watches the price of a stock or an index. So an index is actually a bunch of stocks. So like the ASX 200 is the top 200 stocks in Australia, just as an example of an index. They watch the price movements of those shares or indexes, and they trade in and out of the market, and they try and time the market to make short-term gains. So you're trading in and out of the market. That's what a trader is. And an investor is taking a long-term view of the market, or at least not even looking that closely, just doing some analysis on individual stocks or managed funds or whatever they want to invest in, and just they're buying and holding the investment. So an investor is a long-term strategy, and a trader is a short-term strategy, and they're in and out of the market trying to get gains that way.
On short-term movements. And I know Warren Buffett, probably one of the most famous investors, very much talks about that long-term holding. So I imagine you'd have to be professional and very much into the share market if you're trying to do those short-term trades. So for us average folk, I imagine being an investor, as you've described it, is probably a better approach.
Oh, definitely. And in fact, trading is just it's very specific, and it's a skill set all of its own. It's very technical. You use a lot of graphs and technical analysis, so it's definitely not something I would recommend anybody do as a first step. We should be looking at long-term capital growth in our investment strategy. So everybody on this call or a podcast, I would just say forget about trading and just think about investing.
Okay, good advice. So would you suggest, and if you've got people who are listening to this and they are thinking about trying to build wealth for the long term, does the share market and investing in shares represent, generally speaking, a good strategy to adopt?
Yep. I mean, it's always relating back to your risk, your appetite for risk. And so you've always got to think about how you feel about money, and also how you feel about any loss of money. You need to be aware that the share market can be volatile, and especially in this day and age with the internet and trading and things like that on the markets, that anything that happens overseas can just completely, it can be like a firestorm through the market. So it's sometimes, even though companies and markets are performing well, they could just be it could be something like Donald Trump says something, or or something happens in Europe, or there's a tsunami, or all these things that are happening around us now. That can affect the price of your shares and the share market. So you need to be very aware of that and understand that volatility. And when you're having a long-term view of things, that you need to not think about the day-to-day fluctuation in the share market and take a longer-term approach. So you just need to have that in your mind all the time. And the way I talk about the share market is, the market is like weather. It's like seasons. They have different seasons. So the market can have a winter, it can have a summer, a spring, and a fall, and it does. And the weather is the day-to-day movement. So it's basically, if you just think of it in those sort of terms, it's you just don't want to be thinking about short-term volatility when you're investing in the share market.
So most people would remember the GFC, and obviously there was a massive drop in the share market there, and you've seen the share market rising back up again since that time. So obviously that's playing into that idea of you talking about the different cycles of the share market.
Yeah, well, I mean, the GFC was a pretty catastrophic event. In fact, I've saved every piece of a newspaper article that I had read that week. It was frightening, and the whole markets, they nearly it was nearly free fall. So yes, people lost 40% on the share market, and it has come back up. I mean, the Australian market's really literally just kind of where it is now after 10 years on. The American markets and the European markets came back a bit quicker. But so that's what I mean. You need to be aware that you will make money in the long term, but you can lose money in the short term, and you need to feel comfortable with that. So what I say to people is that if you're going to do any investing, you need to be very comfortable with the fact that you may not have that money around. I mean, it's not that you don't invest. You should always do some investing, but you need to be just being careful with the amount of money that you're putting in and away, and making sure you've got money to live on, and you don't have to sell shares or anything in the stock market when the market's dropped, because that's when you can really do yourself a disservice. So
that gets into the idea of you talking about being an investor, which is more the long term. So if we're thinking about investing in shares, what are some of the benefits? Could you give us a bit of a summary of some of the benefits of investing in the share market?
Yeah, well, the benefits of investing in the share market are a few things. One is that you can really diversify where your money goes, and so the word diversification gets thrown around a lot. And the value of diversification, it just means you're putting your money in a lot of different areas. So if you're buying 20 different stocks in 20 different industries or 20 different countries, then you're diversifying where your money is going. And when you do that, you're actually reducing the risk in your portfolio, and more often than not, you're actually stabilizing or increasing your returns. So that's the benefit of the stock market. You can't do that with property. I mean, we all know how expensive property is in Australia. So even just buying one investment property seems to be out of people's reaches these days. So you don't get that sense of diversification. And the other thing about this share market is you can invest in specific things. You can, if you have an ethical bent towards you'd like to do investing, but you don't want to invest in anything that relates to fossil fuels or weapons or tobacco, you can actually make choices in those regards as well. You can make choices in countries, in companies. So you got all that choice. And the other benefit of it is it is liquid, so that if you do need to get money out, it's a 2 or 3 day trade that you sell down your shares or your managed funds, depending on how they're sort of set up, but you can get your money back pretty quickly. Whereas if you invest in property, I mean, you need to sell the entire property. So with the share market investing, you say you've got $10,000 in a portfolio within the market, and something happens and you need to grab $2,000, for example, you can just sell $2,000 worth of investments and keep the rest invested. So with property, it's you need to advertise it, you need to get it on the market, you need to so it's usually more of a 3 or 4 month turnaround, and that's when people can get themselves into all sorts of trouble, when they have to get out of positions quickly and they can't. So they're the two benefits: diversification, the cost as well. I mean, you don't have to start with a lot of money to invest in the share market. You can buy managed funds. I think they start at minimums $1,000 for most of them. So it's not a lot of money, and you can have dollar cost averaging, which we'll talk about, which basically means putting money in the market every week. So you're not trying to time the market or every month. So it just means that you might set up something. You might start with $1,000 and you might put $100 a month into a portfolio, and you just have that sitting on the sideline, and that's what you do. It doesn't matter what the market's doing. You just keep doing that as a strategy. And when the market is low, you buy more. You actually are buying better. You're buying more shares or more units in your managed fund, and when the market's a bit higher, then you're buying less. But over the long term, your dollar cost averaged in the market, and you actually reduce the market timing risk and things like that. So that's what your super does. That's exactly what your super does. It's every time you get paid, money goes into your super fund. That is a dollar cost averaging strategy into the share market. So everybody in Australia that has superannuation is actually an investor in the share market. They may just not realise that.
Yeah, I remember you saying that in a previous call, that we all are share investors, whether we know it or not, almost. So
yeah, absolutely. Oh, most superannuation funds would be, at least 50% invested in the share market, and half in Australia and half overseas. So you will have stocks and shares in companies or managed funds or index funds or whatever, however your super's been set up. But all of us will have some investment in the share market. So yeah.
So if someone is looking at the share market, and it can be a bit daunting for the uninitiated. How would you recommend someone get started in the share market? Because you've got those online trading platforms like Combank or ANZ as an example, or you've got brokers. What would you recommend is a good way for someone to get started?
Well, the thing with buying individual shares is that you need quite a lot of money to actually get that diversification and get that, getting your money across a few different industries and a few different companies. So you do need you need a lot more to have a quality direct share portfolio. I would say as a first time investor that I would be, when people come to see me, I would always be recommending that they look at managed funds or index funds and buy the index market. So you don't have to have as much money to get exposure to a lot of different companies. So I wouldn't, if you're going to get into the market, I think you need to do some research. I don't think you should just, I think it's a strategy. It's you're putting money into something, you need to understand what you're doing. So there are a lot of, there's stockbroking magazines that come out, or there's, like monthly, you can subscribe to monthly recommendations if you want to buy individual shares, or you can do some research on different sort of stocks. I think I keep going back to the ASIC Money Smart website, and they've got some stuff on some information on stocks, managed funds, ETFs. Exchange traded funds is an ETF. That's basically buying an index on the stock market. So I wouldn't necessarily do it myself. I mean, I've been in this industry for a long time, and I wouldn't recommend anybody just go out without some sort of some at least research and some conversation with someone.
So you said the ASIC website, or the ASIC Money Smart website, which I know you're a big fan of. Are there other places that people could go? Where would you recommend they could find out more information if they were looking at investing in, say, an ETF or a managed fund or something like that?
Yeah, I mean, I would just Google. I mean, there are different companies out there that are actually research companies. So, for example, when I'm looking at researching different strategies for my clients, I use a company called Lonsec. There's a company called Morningstar. If you just look up research houses in the share market, you'll be able to find, you'll be able to have a look. And some of them will have monthly newsletters and things like that. So I think it's just getting onto Google. But yeah, Morningstar's one, Lonsec is one. They're pretty well used across the industry. Stockbrokers will have their own research that'll come through, but they're normally normally have to pay for all those things. So it's just worth having a look.
Good old looking at good old Dr. Google. Is a wealth of information out there.
Yep.
So one of the benefits of one of the benefits of investing in shares is obviously you get those dividends. Now you can receive them as a cash payment, or there's also something called the dividend reinvestment program. So could you talk us through what that is and what you tend to recommend for your clients?
Dividend reinvestment. So when you're buying a share or a managed fund, a dividend is actually the income that you get for investing your money within a company or a set of companies. So you can get a dividend paid out as income, so as cash, or you can get it paid back into your investment strategies, a dividend reinvestment plan. So the benefit of the dividend reinvestment plans is you are usually buying back into the company that you've already invested in. You haven't had to pay brokerage because it's sort of all done in the background. You can accumulate, the benefits of compounding interest is sort of an automated process. So instead of getting the cash, you're continually buying more and more shares, which is great. That's the sort of pros. The cons are if you're overweight in a specific stock, or you're overweight in something and you need to rebalance your portfolio, you might want to be looking at taking the cash and then having another adding something else to your portfolio to give you extra diversification. But just as a general rule, I tend to recommend dividend reinvestment plans, because it's just taking that it's exactly the same as, again, like your super. It just gets reinvested into the market. Whereas if you take it out in cash, you've got to you've got to go again and have a think about it. And sometimes it just sits around for a bit longer. So so they're the sort of pros and cons. It's just more of an automated. continuous investment strategy. But don't, as any investment, you can't just sit and forget and not think about it once in a while. But so.
There are two broadly types of shares that you hear about. You hear about more blue chip shares, which is your bigger companies, more solid history of earnings. Then you've got your speculative type shares. So could you talk us through what the specky shares are and whether that's something you would typically recommend for your clients?
So blue chip shares are really the top quality shares, the top, maybe, in Australia you might say the top 20. There's probably others that are under that as well. But so they're the sort of solid shares. You've got historical earnings. You can see through all their finances. You can look through their annual reports. You can do as much research as you like, or pay for somebody else to have done that research for you. So they're companies that have been around for a long time and are kind of at the top of their game. They're called blue chip, like blue blood. If you think of it like that, blue chip and blue blood, they're kind of high level. Speculative shares are shares that are usually the new up-and-coming companies that don't have a lot of historical data. They may be a little bit riskier. You're sort of taking more of a punt on their potential rather than their historical earnings. So that's the difference. I don't necessarily think people need to get into speculative shares at all. I don't necessarily, certainly I don't as an advisor recommend speculative shares. And in fact, as a financial advisor, I'm not even sure we're allowed to. I think if you went and saw a stockbroker and you said, I have a high risk strategy and I got money that I don't mind if I don't have next week, what have you got to, what can we talk about? Well, then they might have some speculative shares that they can sort of talk you through. But as a long-term investor, I just would be sticking to the blue chip. I just go the best of breed for everything. I don't think you need to go below that. And I'm the same with the super funds. I'm the same with insurance. I'm the same with everything. I really just don't, lenders as well. I just don't go below the best of breed. So I just don't think you need to add risk to things when you don't. Because it's all about safe investing. It's all about making your money work for you. And so taking on additional risks or unnecessary risks, I just think, especially if you're just starting out, I just don't think it's worthwhile. No. It's too stressful. You don't need it.
And with that, that higher risk, higher return, it's not even a guaranteed return. It's obviously a lot. Well, that's why they're called speculative, right? Because there is that opportunity for a higher return, but they're also very high risk that you'll lose all your money.
Well, yeah, I sort of always sort of go back to the word spectacular, speculative, and I think it could be a spectacular gain or it could be a spectacular fail, Yeah. So if you think about it in those terms, I just think, and risk and return are sort of correlated, but that there is no guarantee that if you take on a higher risk that you're going to get a higher return. You're just more likely, you have to take on some risk to get some return. But anything once it gets speculative, it's really you're taking a gamble. And if you want to do that, that's fine. But maybe I would say maximum 5% of your portfolio should be in anything speculative, if at all. So just leave it at that, and then it's more of and consider it a gamble. You're taking a punt on something you really don't know enough about. So
either that or go to the track and bet it on the horses.
yeah, absolutely. Yeah, exactly. Bet it on the horse that you've never seen race before.
Yes, exactly.
That's pretty much, you can think about that. Bet it on the horse that you don't know what the jockey's ever done and what the trainer does and never seen the horse race. That's a speculative share.
Hope for the best.
Yeah.
Now, you hear about people who sometimes borrow money to invest in shares, which is called margin lending. I would imagine if you're talking about people who are just getting into the share market and looking for that long-term, more safe growth, you would recommend against doing that?
Well, it does all relate back to your personal circumstances, but margin lending is, again, there's pros and cons to that. Margin lending is basically using somebody else's money to create wealth. So the benefit of margin lending is that you are actually you are able to put more money in the market. But if the market drops, you're going to lose more money that way than you are if you've just got your own money in the market. So you can double the losses and you can double the gains, or you can do even worse than that. And the GFC, the reason that the market sort of tanked as quickly as it did is there was a lot of gearing, and that's what margin lending is. They'll use the word gearing as well. You geared up to with lend money that you've borrowed. So the downside of margin lending is that it's actually pretty expensive to borrow money in that sort of space, and you're paying 5 to 7% interest. So you've got to make a fair bit of return for it to be worthwhile. If you use your own money, and you make it, and you don't have to be paying down a loan, a 7 or 8% return sounds good. But if you're paying 7% to make a 7 or 8% return, that doesn't make any sense in a mathematical way. So you can be taking on a bit too much risk. And again, I don't think you need to be. When you first start out, just slow and steady. I mean, Warren Buffett's a big believer in not using borrowed money in the share market as well. So, invest the money that you've got.
It's good enough for Warren, good enough for the rest of us, I think.
Yeah. It's just adding extra risk. I think it's just once you get comfortable in what you're doing, that's fine. But I don't think that's where you should be starting at all.
No, perfect. Well, Nicole, thank you for the introduction to the share market. That's been fantastic. If someone wanted to find out more about the share market or how to get in touch with you, how can they do that?
Well, more about the share market, I'd say Google, get onto ASIC Money Smart website, do some research around that. There's plenty of, Alan Kohler is a great, he puts out a lot of good articles on what's going on in the share market. He's the finance reporter for ABC. He's been around for a long time. So people like that, you can read up what they're saying and get some more information. And if you want to have a chat about your specific circumstances or just catch up and have a chat about what you're considering doing, then you can contact me. And my number is I'll just give you my website is Nicole Heals Financial, and my name will be on the podcast somewhere, so you'll be able to see how you spell that. But yeah, give me a call and we can have a chat. But my whole philosophy about advice is you never do anything that you're not 100% understanding. Don't put your money in something you don't understand. And so if it takes a little bit longer to understand something, that's nothing wrong with that.
No, perfect. Well, Nicole, thank you as always, and we'll look forward to speaking to you again.
Okay, thanks. Michael.
Bye.
Bye.